Who benefits from inflation? This is the question Professor James DiLorenzo asks. Welcome to Philosophy Insights. The FED has been a critical player in the upward trajectory of inflation rates, a result of its long-standing policies of low interest rates and expansive monetary supply. As such, it often undermines the economic stability it's supposed to ensure. Central to this argument is the Fed's reliance on keeping interest rates at historically low levels for extended periods. This approach saturates the market with cheap money, reduces the value of currency, and diminishes purchasing power. As businesses and consumers find themselves flush with accessible capital, demand outstrips supply, driving prices upward. This is not merely theoretical. The aftermath of the 2008 financial crisis and the economic response to the COVID-19 pandemic provide clear examples. Post-2008 and more accurately, post-2020, the Fed's policies have kept interest rates near zero, encouraging borrowing and spending in ways that the supply chain simply could not keep up with, especially given simultaneous disruptions and logistical challenges. But who benefits from this? Here is DiLorenzo.
Well, debtors, of course, benefit from inflation, and the federal government is the biggest debtor, so that's item number one. And item number two that I wrote down here is something that maybe you're not all familiar with, is as Fed orchestrated bailouts. And when the Fed has always financed bailouts of one part of the economy or another, and this is ruinous of capitalism, isn't it? You might be familiar with the famous bailouts of after the 2008 crash, and what that did was to tell these bankers, Goldman Sachs and Citibank and the rest, profits are yours, the losses are theirs. You know, the taxpayers will cover your losses, profits are yours. That's ruinous of capitalism. That ruins the profit and loss system. You can't have a capitalistic profit system if you have this system of fascism, basically. And years ago, I actually wrote several articles with titles like Economic Fascism. And one of the things that was a characteristic of that in Germany and Italy in the early 20th century was massive bailouts. And when fascism was, they allowed private property, but it was very heavily controlled and de facto a part of the state. And so they had to bail them out. And so that's what the Fed has been involved with. For example, in the 90s, there was a whole spate of these. There was one thing that they called the tequila crisis. Now, for those of you who are tequila drinkers, it wasn't that there was a shortage of tequila anywhere. It was that the Mexican peso was devalued, and the American big banks, Citibank, Goldman Sachs, had been buying Mexican bonds big time, and they were stuck. The Mexican government was threatening not to pay. And so Alan Greenspan works hand in hand with the White House to orchestrate the bailout, so-called Mexican bailout, but it was really a bailout of Goldman Sachs, once again, and the big banks that had borrowed all this money, were holding all these Mexican bonds. And then there were these genius academic economists who started working for a firm called Long-Term Capital Management. And that went bust, and they ended up getting a $13 billion bailout, and that was Greenspan's work also, along with the White House. Citibank, $45 billion in loans from the government, and a guarantee that if they had $300 billion and more in losses, that the government would cover that. And in return for that, the government demanded equity in Citibank. Yeah, how's that for socialism there?
Also note that the Fed's quantitative easing programs, which involve large-scale purchases of government securities and other financial assets, have ballooned the money supply, further exacerbating inflation. By increasing the money supply, the Fed decreases the value of the dollar, which means consumers need more dollars to purchase the same goods and services. While what Fed claims is that this provides liquidity to struggling sectors and stabilized financial markets, the long-term effort is a decrease in money's purchasing power, effectively increasing inflation.
Then, of course, the Great Recession in '08, the maestro, as Greenspan was called, the Fed printed twice as much money in 13 weeks as it had in the previous century to finance the bailouts of various parts of the economy. And David Stockman's great book, The Great Deformation, gives chapter and verse of what was going on here, and that the big lie was that the economy would collapse unless companies like Goldman Sachs, once again, the financier of the political class in Washington, was bailed out. The big insurance company, AIG, had to be bailed out. And David Stockman points out that after the big bailout of Goldman Sachs, 6 months later, it was always solvent. There was never any threat of them going under like Lehman Brothers. They paid themselves $16 billion in salary and bonuses. And just 6 months earlier, the entire economy was going to go into the Great Depression again if this didn't happen. I remember Bush saying that. So Greenspan and the White House conspired in all of these bailout examples, which tells you how ludicrous the idea is that we have an independent Fed. Since its very beginning, they have claimed that the Fed is independent of politics. If you ever saw the movie The Big Short about the '08 crash, one of the very last scenes was not a movie scene; it was an actual NBC News scene of the Fed chairman walking out of the White House. I don't know if you remember that from the scene. And that was the chairman of the independent Fed walking with the White House. And so that's how it works. And so the bureaucrats from the Fed and political hacks from the White House in every administration meet weekly. Yeah, the weekly meetings. So there's no independence. There never has been. And in return for all this, of course, the Wall Street banks lavishly financed the careers of the politicians. And the note I wrote to myself here is organized crime on steroids. And another thing that's created is my old professor, James Buchanan, who won the Nobel Prize in 1986, I guess it was now. It's ancient history now. But he wrote co-authored a book called Democracy in Deficit, and they had a big section on what's called fiscal illusion. And it's not the kind of thing that students would read about that much in a textbook. But fiscal illusion is a simple idea that, printing money to pay for government programs makes the perception of the cost of government lower. And it doesn't seem like it's expensive.
Inflation is often portrayed as a universal scourge that diminishes purchasing power and strains consumer budgets. However, this rising tide does not lift all boats equally. In fact, some sectors benefit significantly from higher inflation rates. One example DiLorenzo does not mention is that owners of real estate often see their investments appreciate in value during inflationary periods. Real estate is traditionally seen as a hedge against inflation. As the cost of new construction rises due to increased prices for materials and labor, the value of existing properties typically increases.
So even Adam Smith, in his famous book, The Wealth of Nations, in 1776, pointed out, he said that wars would be less frequent and shorter if they were financed by taxes. And he was really expressing this idea that Buchanan called fiscal illusion, that they make the perceived cost of war lower, and everything else, not just war. The Fed, when it was created in 1913, it financed about a fourth of World War I. And so there might not have been American participation in World War I had it not been the Fed in existence. And of course, the income tax came in also at the same time. And the top rate went from, it was originally 7%, and it went to 77% because there was an emergency after all, the war, as far as they never did go back down to 7%. Okay, and so that's one example of who benefits from inflation, and of course harming the economy with inflation causing boom and bust cycles and just price inflation creates economic instability, depressions, recessions, and that's all good news for the welfare bureaucracy, isn't it? Because it increases the demand for welfare bureaucrats, and so life is always better in Washington D.C. when the American economy crumbles. And I lived it when I worked at George Mason. I lived in the swamp for 8 years. And so I was able to observe that, good or bad, it just keeps on growing no matter what happens, but especially when it's bad, as far as that goes. Political business cycles. There's such a thing, there's a literature in economics called political business cycles, and we're about to enter one now that says, if you take a course in macroeconomics at a university, they'll teach you how to stabilize the economy. They'll make statements about how the purpose of the Fed is to stabilize the economy. Here's a famous one that many generations of American college students were taught about what the Fed does. Okay, this is from Paul Samuelson's famous textbook. It said, the Federal Reserve's goals are steady growth in national output and low unemployment. Its sworn enemy is inflation. Paul Samuelson. If aggregate demand is excessive so that prices are being bid up, the Federal Reserve Board may want to slow the money supply. When has that ever happened? Thereby slowing aggregate demand and output growth. If unemployment is high and business is languishing, the Fed may consider increasing the money supply, thereby raising aggregate demand and augmenting output growth. In a nutshell, this is the function of central banking, is to make everything stable and prosperous. And that's what generations of college students were taught about the Fed. But the political business cycle, and then there's a big literature on that, introduces some common sense. In this book by my old professor, James Buchanan and Richard Wagner, Democracy and Deficit, where they talked about fiscal illusion, also talks about the political business cycle. We're in an presidential election year now. And so if the current Fed chairman wants to keep his job, he has to start increasing the money supply and do things that the incumbent party wants to do if he wants to keep his job. And this has happened in history over and over again. There was an economist named Robert Weintraub who published some academic journal articles about this. It goes from the 1950s through the 1970s. This is an older article. And every time a new president comes in, they lets it known if he wants faster money growth, or if there's already price inflation, he wants slower money growth, the Fed chairman does it for him because he wants to keep his job, just like every one of you does who's working. You want to keep your jobs, right? You don't want to get fired. And so does the Fed chairman. And so there's built-in instability.
Thank you so much for watching. If you enjoy videos like this, please subscribe and hit the notification bell.